So look at multiple ways to put your money in so that, maybe you're doing a mix of 0% capital gains and an IRA withdrawal, and you've got options. You've got some plans in place so that if one asset's better to draw from than another in any given year, you've got movement to save in total.
Yep.
But if you're singularly focused on how you invest, you can find yourself to where you're limited on options.
Hey everybody, welcome to the Blue Collar Wealth Podcast. We call it that because this is a show about real finance for real people. And we often get asked, what kind of clients do you guys work with at Stonehouse? And the term I always like to use is blue collar wealth. Most of our clients have anywhere from $500,000 to many millions of dollars saved up in their retirement, but they have no desire to gamble it away or, at a casino or anything, or even through a high risk investment. Instead, most of our clients are asking us about how do we squeeze more juice out of our retirement and live that long, happy, healthy life. My name is Bob Brown. I'm a certified financial planner and a founding partner here at Stonehouse Retirement Income Planners. I've had the privilege of helping many families plan and live their lives for over 20-some years now. I'm also part of a growing team here at Stonehouse. We've seen our clients go through a ton of different things in their lives. And now, thanks to the beauty of this podcast, we get to share some of those stories, maybe even some shortcuts to hopefully get you on track or stay on track with your own finances. So in this episode, we're going to focus on how you can keep more of what you earn. Whether you're building your nest egg, you're trying to sustain your retirement, or passing money to your heirs, or running your own business, or managing your royalties, knowing which taxes apply to you, it's invaluable. Not knowing about or failing to act on opportunities can cause you to have to pay heavier taxes and even face fines or simply not knowing. And remember, when it comes to the IRS, ignorance is no excuse for failing to pay. So if you're feeling stressed or concerned and asking yourself, am I taking advantage of all the opportunities that are out there for me? Or am I missing something that I should be doing? You're not alone when it comes to feeling like that. In both of our Stonehouse companies, the accounting office that we have, as well as the investment office, we believe that these valuable parts of your life should not be isolated or compartmentalized. And what I mean by that is that your accounting professional should be coordinating and collaborating with your investment advisor or your planner or your attorney or whoever you've trusted to manage these various but very valuable pieces of your life. By the end of this podcast, I hope we're able to show you how to look for flexibility in your financial life. If you don't have much of it, try to create more of it and do it through proper planning. And flexibility means having your assets invested in different things and even in different places. It can also mean you have cash flows coming in from multiple sources. And most people don't realize that turning on or off these certain income streams, or maybe holding off on a sale or a purchase of an asset, can dramatically change your tax liability in any given year. And if that sounds like you, then sit back and enjoy this conversation with Ben DeNault. Ben is a CPA. He's one of my partners at the Stonehouse Accounting Office, and he really brings fantastic leadership to our entire tax team. We're going to talk about some of these specifics, some of these tactics and these maneuvers that we're seeing with our existing extensive client base, and we think it just might make a lot of sense for you too to listen in and enjoy what we're going to talk about. So here we go. So Ben, thank you very much for taking. I know accountants are always busy. Doesn't matter what time of the day I ask you, can I steal an hour or something? Like an hour is a big ask. So thanks for giving me at least a couple of minutes to go through this list that we want to hit today. I just basically was hoping that I could pick your brain and you can help some of these viewers understand whether they're individuals or they're running their own small business.
Sure.
Or we're doing a lot of natural gas royalties. And so all these different kinds of categories probably have a bunch of little things they can do to kind of tweak their tax situation, or at least take notice to see if they're doing it the right way.
Yeah, absolutely.
So all right, let's start with the individuals. Okay.
Sure.
One of the things I want to talk to you about was capital gains, taxation, as well as you like to mention the qualifying dividend. So you want to talk about that for a sec?
Yeah, sure. So something individuals can do is take advantage of the favorable tax rates for that class of income. And everybody focuses on the capital gains tax rates and forgets that qualified dividends are treated the same.
Right.
So your qualifieds are stocks you've had longer than a year. You get your qualified dividends. Well, there's ranges there of 0%. 15%, 20%. A lot of people are surprised to hear there's a 0% bracket on
Sure.
that income. And it's not as small as you would think. A married couple can have an adjusted income of about $100,000. And then after the standard deduction, which is like 20, 27, 28, they'll have taxable income low enough that they're at a 0% rate on their capital gain and qualified dividend income.
Right.
And that can, really be a huge benefit, especially if you're trying to stretch out your assets approaching retirement.
And to me, that seems like we just talked about on the introduction about flexibility, right? Finding flexibility. So if you can have the flexibility to maybe sell, in some cases, people might have too much of an asset. So if they sell it all, let's talk about a stock, right? If they sell all of that stock, it might push them over those limitations and be in that out of the 0% bracket, right?
Yeah.
So we could sell maybe half this year and then wait till the following year.
Yeah. You just be careful. Keep track of where you're at. Work with your advisor so that they know what your other income is. It's a team game here. So bring in everything you've gotten before you make decisions on selling your stocks. And try to stay in those brackets to pay as little as you can if possible.
Right. Yep. Coordination. Love it. One hand talking to the other.
Right.
What about Social Security? That's a big topic we often hear about when it becomes taxable, when it's not, and how much.
Yeah. So it's a pretty low threshold to where Social Security starts to be taxed. Most everybody has at least some of their Social Security taxed. Once you get over $20,000, you're getting in that range with Social Security where you're going to start paying some tax on it. Up to 85% of your Social Security can be taxed. And just remember that Social Security doesn't have any withholding on it unless you ask them to.
Right.
So if you're in a position where your Social Security is being taxed, be aware that unless you've directed them to withhold federal income tax on it, that it's probably taxable and you probably have no tax paid on it. So, just keep that in mind, and keep in mind that it will come into your taxable income for that first part of the discussion we had. Right.
Sure.
If you're going to have those dividends and gains and be trying to stay under that, know how much of your Social Security is going to be taxed so that you can make the right decision.
Yep. And one of the top subjects that always gets asked of us, or comments that get made, is it seems really unfair that I get taxed on my Social Security given all the work that you did to put it in there and everything. And I guess for our viewers' perspective, it's important for them to know neither you nor I have any control over that. Those are the rules we have to play by.
Yeah, we're just the messenger there. It is important to remember on that topic, though, that the ordinary taxpayer recovers what they've paid into Social Security pretty quickly. As a general rule, it doesn't take you long to get back what you've paid in.
Yeah, that's a good point.
Now, if that money was in an index fund instead of Social Security the whole time, maybe it would be worth more. But
yeah,
right. But
don't open that can. Don't
right.
But so on that social type of program against Social Security, we also have Medicare. So we have something that we reference called IRMA, which is an acronym IRMAA, which stands for Income Related Monthly Adjustment Amount. You want to talk for a second about that? Because I know a lot of people are unaware of that until it hits them.
Yeah, it surprises a lot of people. So your Medicare that you have to pay in is actually income based. So when you get into higher incomes, you will have that adjustment come through, and it can be pretty substantial. The maximum compared to the minimum, there's over a $400 a month difference there if you get into that max rate. So it's just something to be aware of, that okay, I'm making more money. Am I going to have to pay more towards my Medicare? I'm not going to tell you to go out and make $50,000 less because you might have to spend $300 more a month on your Medicare, but I'd like to inform people it's out there so they're not
That's
surprised when it comes.
And if they can control it to some extent, you're talking hundreds per month over how many years that you're paying it. It could be thousands and thousands of dollars.
So yeah, if you're gonna trickle over that line by $10,000, well, don't sell something. So you stay under it if you can, if you know where it is.
I'm sorry we're doing like rapid fire here, but I just want to cover a bunch of topics. Tax loss harvesting. Now, in our industry, I know a lot of firms, a lot of advisors always get excited. There's a percentage of them that get excited about tax loss harvesting, and then there's another group of people that say that I don't pay any attention to that. What's your mindset on that? Can it be good, or is it a pain?
It can be good. I think you have to consider it. You need to sit down and look at your portfolio and ask your advisor if there's a couple of losers in the portfolio that they don't think are coming back. Right? I mean, if you have some bad holdings in there because things happen, and you're in a position where, okay, I'm going to cross and I'm going to have a Medicare adjustment, or I'm going to end up in the 15% gain rate instead of 0% gain rate, and you have a couple of bad stocks that can get you back where you need to be, sell them.
Right.
But don't sell good stocks just because they're down and you need to get away from something, right? If you're getting a good return, just because it's down today, if you have a reasonable expectation it's going to make you more money than the taxes will be, well, then you keep it. But I don't like selling just for the sake of taxes only. But if it's not a great stock and it can save you in the long run, sure, go for it.
Yep. That's we run into that a lot, and I would say it depends on the size of whatever you have invested, right?
Yeah.
If it's of a point where you're talking a $10,000 brokerage account, that's probably not something that's really going to move your tax needle.
Sure.
But when you get in the hundreds of thousands or a million plus, you might be able to get some serious advantages there.
Absolutely.
Yeah.
Yep.
Rapid fire. The next one, using QCDs. To offset maybe RMDs that are required. So let's talk about that.
First of all, get rid of the acronyms.
Sorry.
It's usually my fault.
No, you're right. I went too techie and geeky on you.
So the QCDs qualified charitable distribution, and then the RMDs required minimum distribution. So in an IRA account, once you are of age, once you're 72, and you have to start taking money out of that account, or you're penalized pretty heavily for not taking them. What a lot of people don't realize is that if you were doing charitable contributions before, you contact your administrator of that account and say, hey, I want you to send $3,000 to the church, or $3,000 to your favorite charity, or whatever it is, as long as it's a qualified charitable organization.
Yep.
If that money goes straight from the IRA to the charity, you don't have to bring it in as income. That's far better than the standard deduction where you have to exceed the standard before they even count.
Right.
So you can have $15,000 in charitable giving on your itemized schedule, and it doesn't even beat the standard. So if you have to take those RMDs, you weren't necessarily excited about it or wanted to bring your account balance down, but you're forced to, well, you can send it to charity that you maybe would have done anyways, and get a lot more benefit that way.
And the key secret, the ingredient there is to do it directly from the custodian, wherever the IRA is, directly to the charity.
Yeah, and it has to be an IRA.
Right.
Yeah, you can't do this out of your company's 401k plan. So as you approach retirement age, that's a good reason to maybe roll some money out of the employer plan and into an IRA account so that you can take advantage of it.
Yep, great. Yeah. Let's talk about, this is a weird topic for me because it's sort of new to me as well. So I'm going to ask your opinion on this. The 1099Ks. So this happens because, this is a newer thing because of, I don't know if the word is digital currency. That's not the right term, but a transfer between, we're talking Venmo, PayPal, electronic transfers. I shouldn't say digital currency. Electronic transfer. So it's my understanding that Venmo and PayPal are now going to start generating 1099K forms to people who have certain number of transactions in a given year, or somebody that receives a certain volume of payments per year.
Yeah. So without getting into the specifics of how much or whatever, all I would say on it is the 1099K form has been around for a long time. That's what a store gets from their credit card processor. It just tells them what their receipts are through that service are. For your individual, if you're in business, those forms don't really matter to you because you're keeping track of your sales and reporting your sales already, as long as you're being a compliant taxpayer, which I hope everybody is out there, right? What people are concerned about is, okay, that's the IRS involved with their fingers in like my everyday banking activity. Well, unless you're trying to hide something, that really isn't going to affect you too much. You brought up okay, well, if I'm paying my buddies back for whatever, my fantasy football league dues or something,
I usually owe at the end of that season.
Yeah, right. If you're doing those small transactions back and forth, it's not like you have to then go and put a Schedule C business on your tax return to report this money. You're not involved in a trade or business. And if you ever were to get an audit from the IRS over that, which I find unlikely for such a small dollar amount, you would just have to explain to them that you're not involved in any trade or business and go on your way. It doesn't make it taxable income just because it showed up to you on a 1099-K is the short story.
So don't panic. You get a 1099-K.
Don't panic.
Right?
Yeah, if you got a 1099-K, don't panic. You don't have to pretend you've opened a business, right?
Right, okay.
You're okay.
Yeah, that's another can of worms there too. Okay, that's great. What about, so this topic here, Ben, you actually brought it up when I first talked to you about sitting down and chatting about this, which was, it's basically, people know often how to diversify a portfolio. At least people are getting more educated than ever about, I want some stocks and bonds and real estate and cash and everything else. But you were talking about also on how it's taxed.
Yeah.
Right?
Yeah.
Getting a good mix in there. You want to expand on that just a smidge?
Yeah, so we've all been told to diversify our investments, right? And yes, that means inside your portfolio, inside your brokerage account, inside your IRA account, you should be in a variety of things. We all know that. But you should also be invested in a variety of ways so that you have flexibility in the future. If you put all your investments into your IRA account, well, when you reach retirement age, you're going to get ordinary income taxable withdrawals from your IRA account. And that's what you have. There's not much shuffling, right? The IRA allows you flexibility so you can buy, sell, trade, swap the entire time up to retirement age without having to pay tax on it.
Yep.
But then once you get there, that's it. It's ordinary income when you take it out, other than what you send to charity.
Yep.
So maybe you do some IRA, some brokerage. Maybe you look into a Roth, or if your income is too high, you can do a backdoor Roth. That's too complicated for today. But
that's a whole other conversation.
Yeah. So look at multiple ways to put your money in so that, maybe you're doing a mix of 0% capital gains in an IRA withdrawal, and you've got options. You've got some plans in place so that if one asset's better to draw from than another in any given year, you've got movement to save in total.
Yep.
But if you're singularly focused on how you invest, you can find yourself to where you're limited on options.
Yeah. In the office, I refer to the F word as flexibility, and
yeah.
So that's how you gain flexibility, right? You multiple accounts, multiple locations, different taxation. Now all of a sudden you've got a lot of levers you can pull in any given year. You, with whatever team you have, your planner, your accountant, your attorneys, you guys can pull and move levers, stay within certain tax brackets, and just efficiently manage your picture. You're not going to avoid all taxation,
no,
but you're going to hopefully avoid paying any excess that you didn't have to.
Right.
So love it. Last one I have on that is one thing also that you brought up, which I honestly don't hear this from like CPAs, which is focusing on the long-term picture versus just the one-year tax bill.
Yeah.
I've always pushed up against that because I always feel, in defense of accounting professionals, you're often judged on how much of a refund you can find. It's judged on that one moment in that tax year.
Sure.
And I find super refreshing when I talk to accountants that are always thinking like, what's your 5-10 plus year plan?
Yeah.
Which you've always been focused on, which I appreciate.
Yeah, it's hard. I mean, just take this year as an example, right? I mean, we've got a position now where the stock market has corrected down pretty heavily over the past few months, and
2022. I don't know when this.
yeah, right.
People might watch this like a year from now and go, "What are you talking about?"
Right. But there's probably a lot of people in a position right now where they could sell a bunch of losses and recoup any estimates they've made and their federal withholding, and it's losses are limited to what you can take, so it wouldn't wipe out all your income, but
it helps.
It helps. If you've had other investment class income, you can do things in a year and drive that tax burden way down in 1 year and get a good refund. Well, good job, but does that help your long-term goal? You could be talking many more tens of thousands of dollars in savings if you focus on the long term. If you focus on putting yourself in place where you have that flexibility where you can live at 0% tax. I mean, it's just, that's the simplest example. And you guys have it with a lot of your P&G people that they're able to retire at 55 and stretch that money out with 0% gains, which really allows them to retire. If they were giving 20% of that up in taxes because it was just a standard retirement draw, it might not work. Focus on the long term. Put those flexible things in place so that when you're getting, now don't ignore the year, right?
Sure.
Don't go try to have a big tax bill this year saying, well, I'm going to save it when I'm 75. Well,
nothing wrong with a bigger tax bill, right? As long as it should translate into lower taxes for future years so that the cumulative decade is a lot less than you would have paid doing it the other way.
Exactly. Right? Don't hyper focus on the short term because your tax plan is a long-term plan and eventually wraps into your estate plan and all that works together, and that's long term. It's not just today.
Yeah, that's awesome. All right, I'm going to shift from most individual taxpayers. We'll shift over to the business side of things. Corporate structure. We talked that it's more than just about liability.
Right.
You want to expand on what you mean by that?
Yeah. So, the first reason why a lot of people incorporate is for liability purposes. No problems with that. That's the primary goal on that front. But okay, you're going to incorporate. How are you going to incorporate? Right. And the how question has a lot to do with your taxes and your income and how everything's going to be treated. Small businesses, they need to take a look at what their structure is going to be. We like the LLCs because they're very flexible. You can change your status with an LLC. You can't do it every year. You can't just swap around how you're taxed every year. There's a waiting period anytime you make an election. But you need to look at it. A C corporation might lead to some double taxes. It gets taxed inside, and then if you take it out, it gets taxed again. In some cases, they do make sense. If there isn't going to be those dividends out, it's a flat tax. It might be better than your personal rate, but more times than not, that dividend tax seems to creep up and rear its head eventually.
Right.
But likewise, if you're a partnership, well, you can't take a W-2. And without a W-2, you can't have an employee retirement plan that can do a deductible match. There's all these things you have to look at to how do I have this vehicle? How do I make it the best vehicle?
Yeah. And it's usually, unfortunately, I would say the natural transition or life cycle of a business is not, people aren't going into business to figure out, let me first figure out the proper structure. No, it's about like, I have a skill set. I'm good at doing this, or I'm creating this, or I want to build that. And they do it and they start to collect it. And it's usually just on their Schedule C or something, right? Yeah. And then they start to, somebody says to them, oh my gosh, there's liability here. You should protect yourself. They make it an S corp or they do some sort of legal entity.
Yep.
But it's really there. I don't think people really understand all the options that are out there and all the little nuances that come with every decision.
Sure, right? Absolutely. Yeah, each one has its pros and cons, right?
Yeah.
You do the S corp, and I mentioned it lets you have a W-2. It also means you have to have a W-2, right?
Yeah.
So unless there's no profits, then there's no profits to have a wage on. But we hope that's not a problem for anybody. But yeah, you need to sit down and have those conversations. What I often encourage new business owners to do is to just do the simple, you can be an LLC and still be on a personal return on a Schedule C. but at least you've got the vehicle now. You can get your feet wet, you can get your business going, and then you've got it inside this shell that you can make decisions with later,
Right.
once you've gotten yourself up and running.
Let me ask you about, you mentioned unless you have no profits, right? A few
Right.
seconds ago. I know we talked about that businesses shouldn't be surprised at the end of the year if they have a profit. So
Yeah.
you're a big fan of sort of monitoring this on a monthly, quarterly basis. What do you recommend to clients that you work with?
Yeah, I mean, at least quarterly. You should be able to sit down and go through your books. A lot of people have gotten where they're trained enough on their own that they can just give me a call and say, "Hey, my profit is about this much," and I know they've been doing it long enough that they're going to be pretty close to right. But you just have to be careful if you're doing your own books and you're not an experienced bookkeeper.
Yep.
You might have some stuff expensed that at the end of the year I'm going to say, no, sorry, you can't write off that bathroom remodel.
Yeah.
Right? That
Yeah.
doesn't all get written off this year. And I add to your profit, now you have, surprise, there's a tax bill.
Right.
So you do need to review your books probably every quarter. And if you have questions, if you run your income statement and there's a few items in there that you're like, ooh, maybe I can't write that off right now. Well, you need to make the call, and you need to know where you're at before December. Because if you don't know until December, you're down to a limited time to make decisions and make moves to fix it. And what you need to do to fix it is probably go buy stuff. And those people they're coming out of Thanksgiving and headed into Christmas, right?
Yeah.
December is not always the best time to
Right.
go try to make big purchases. It doesn't always work.
When you talk about that, the best way, the easiest way to monitor the software people are using, like whether they're using QuickBooks or some other accounting software, it's very easy to print the profit and loss statement for the quarter, for the year to date, or whatever. But it's worthless if the data entry is not there.
Exactly.
If it's not correct.
Yeah,
So a lot of people get like, I'll get to that, and they just builds up on their desk. And
Right.
that's, I'm sure, where you run into the frustration. They don't want to get you that profit report because it means I got to sit down for 2 hours. So
Yeah.
try to keep that balance, I guess.
Yeah, there's plenty of that, and I feel for a lot of small business owners who haven't, that aren't staying caught up on that kind of thing, and aren't sure if they should be paying for it to be done. Oftentimes paying for it to be done so you can make good decisions will save you money in the long run.
Yeah.
But I can understand the hesitation. But yeah, you have to have quality numbers to make decisions.
Yep.
And catching it all up at the end of the year is a tough way to go.
Yep. All right, I'm going to shift you. That was quick on business. We did individuals. Now let's switch real quickly to natural gas landowner, royalty owners,
Right.
basically. A phenomenon that is happening, and it's a great thing for that demographic, is that they have seen some income of recent that they haven't in the past, or they were getting it and it's accelerated probably by the time they're watching this as we're winding up 2022. So my question to you, Ben, is as they're seeing a surplus of income that they're inevitably going to have to get taxed on, going back to our previous conversation on the individual side, right? Are there things a royalty owner can do to help offset that, sort of take that flexibility and use it for good?
Yeah, absolutely. Again, you need to look at your whole situation, right? So if your royalties have gone up far higher than they were before, well, what else maybe needs to come down, right? Because we all have our area where we comfortably live. This is the amount of cash we need to live our current lifestyle and all that good stuff. Maybe you do want to use some of the royalties towards having a better lifestyle. That's great. That's more power to you. But if you're trying to stretch out retirement, maybe you retired and it was kind of close. Maybe you retired at 57, but your advisor was saying 59 was more like it, right?
Right.
So if you're
That
trying to
almost
do
never
that, right, take advantage of those royalties and reduce that retirement draw. Maybe do those things so you can stretch out what you have, lower your overall tax burden by staying in the same bracket instead of just making more royalty and paying more in tax on the other classes of income, when you could be saving that stuff for farther down the road, because the royalties can go away.
Right.
And regardless of world events and all that stuff, we've seen the prices go from $2 to $9. They've really gone up. But even so, even at $9, you can have a problem on the well pad that pays you.
Yeah.
Right? They can
Yeah.
come turn those valves off. So you don't use them, change your lifestyle, make big purchases, and plan on it being a consistent revenue stream, because it might be, but it might not be. And there's certainly much more risk on the might not be
Absolutely.
side. So.
Yeah, make hay when the sun shines. But so if I'm in retirement and I'm at the age 72, so I need to start taking money out of my IRA, I can do what to adjust?
So yeah, well, you're probably taking more than the RMD if you're of that age.
Most
right?
cases,
Most
right.
cases they take more than the required minimum, because that's their income for retirement. They need more than the minimum. But maybe you only take the minimum. There's certainly no harm in that, and it stretches it out. Might leave more of a balance in there to leave to the kids. Great.
Yeah.
If you don't need to take it, if you want to take it and enjoy yourself, go for it.
Yeah.
Right. But just don't plan on it being a long term. Like, this is going to be the consistent everyday picture.
Or you could use what we were talking about before with the qualified charitable distributions.
Sure.
Right?
Yeah, absolutely. If you're making more in royalty, you don't need as much of the IRA, and you want to do some good in the community. Yeah, take advantage of those QCDs, and don't bring all that IRA money into your income.
What about if I'm still working, fortunate to get a royalty check now, and it's more than I thought. And now there's other ways, right? With dialing up your contributions to your 401k or your IRAs or whatever.
Absolutely. Yeah, if you're in a company plan, you can withhold quite a lot. Most people are doing a few percent or whatever, but you can really take advantage of what you're putting into your 401k, bring home less taxable wage. If you're self-employed or whatever, and you're in an individual IRA account, get that contribution up to the maximum, and consider opening that brokerage again. Back to that. Invest in multiple ways. If you have already done the 401k and you're getting the royalties and you're still going, I've got more cash than I need, well, do something with that cash.
Right.
Get yourself set up so maybe you can retire earlier and live off tax-free gains for a little while.
Yep. There you go.
Put it to use.
Great. That's awesome. Let's talk for a brief second, a couple minutes about entities. So a lot of natural gas landowners have put that land or the gas rights into an entity, family limited partnerships. Perhaps there's probably an LLC involved as a general partner of that.
Yeah.
Various ways that attorneys have helped people set them up. In a lot of ways that people are managing or sometimes mismanaging, most of the time probably out of just not understanding or not maybe being educated on what they're supposed to do after this thing gets established.
Right.
So a couple of things we made notes of to talk about depletion.
Yeah, so depletion's at the individual level, not on the partnership return. Right? But on the partnership return, there has to be some indication of what your gross royalty is so you can take the right amount of depletion. It's usually a supplement to the K1 where you put in what the gross royalty is. But and make sure you're taking that 15% depletion. It's a free deduction.
Right.
Really, it's not a, most of the deductions you're allowed to take on a tax return are actual cash spent.
Right.
That's one where you don't have to actually spend the money to claim 15%, as long as you have enough taxable income to take it. Yeah.
How about other deductions? And where do we get into some gray area where people are maybe taking deductions that shouldn't be?
Yeah, so it's really not so gray. Natural gas royalties, and everyone out there that's getting them knows that they don't really cost you much of anything, right? So I see people take their real estate taxes. They come in, they're taking their real estate taxes, and they got a tractor on there, and I got to take care of the property, and I got to pay the taxes. Well, everything on the surface of the ground has nothing to do with that well leg that runs underneath it, right? Your real estate tax assessment does not change because they have natural gas on your property.
Right.
At least in Pennsylvania. There's some states that do charge an assessment on royalty interests, but in Pennsylvania there is none. So to deduct your real estate tax, they're not related expenses. So it's not a very good place to try to get aggressive and take deductions against the royalties, because it's not something that'll hold up if you get audited, right? And anytime that happens, it's not a nice position to be in.
People are worried about, higher percentage chance of audit because of, most recent bills that are getting passed and
Yeah, and
increased audit agents and IRS agents.
LLCs and limited partnerships will be an area, a higher audit area. They always have been. So you add more agents, and those partnerships are more likely to be audited. Now, I do like those partnerships. I think they're great estate tools,
Exactly.
just as much as tax tools.
Right.
You
What about oh, go ahead. I'm sorry.
you think about the the family that owns a decent amount of royalty producing land, and it can be a sizable sum of money. If it's just going to one married couple, say it's the grandparents, and they're getting all this money, well, they might be paying tax at 30%
Right.
on it. I see this scenario quite a bit where they're paying tax at 30%, and then they turn around and gift regularly to the kids and the grandkids.
Mm-hmm.
Well, the gift is not deductible, right? They're just giving them cash, which is allowed. That's fine.
Yep.
But you're paying tax at a much higher rate. Where if you have this LLC tool, you can say, okay, 10% of the royalties belong to them. Maybe they're at a 12% tax rate,
Right.
right? So I mean, your more money is inside the family, and they're getting better advantage of it,
Yep.
straight to them, and you're not stuck filing gift tax returns and paying tax on the full sum. So
Yeah.
it makes a nice little vehicle to flow it through.
Talk about building flexibility, right?
Yeah,
I mean,
right.
you don't have to gift any given year. It doesn't have to happen every single year. It can happen all at once. It's usually probably best to do a little on a regular basis.
Yeah, so with the LLCs and LPs, there's a common misconception with these that I see, that people think because they're a pass-through entity that the money has to go straight through 'em. So you have $2,000 January 1, December 31st, you have $2,000, and it goes straight through by percentage. That's fine. You can certainly do that, but that's all it will be.
Yeah.
You could have done that with the deed,
Mm-hmm.
right? And,
Right,
you
right.
could have just deeded the royalties to yourself and the kids and grandkids or whatever by percentage and skipped the partnership at that point, because it's not really serving any really useful purpose at that point. You gifted the royalty interest through the deed. You can use the LLC to build a fund that protects the land, keeps the land in the family, protects that asset for generations to come. Not all the money has to go through. What I say is to send enough money through at a minimum so that everybody can pay their taxes on their share of the royalties,
Yep.
right? You don't want to
Yeah.
leave all the cash in there and then here's your K1, go pay your taxes.
Exactly. Yeah.
That doesn't make the family very happy. But
Makes Thanksgiving pretty tough.
yeah, right. But yeah, you can save some, set
Yep.
some aside every month and build up a fund inside that LLC, and maybe the family can borrow from it later, or, all kinds of things.
Yeah. And I don't mean to make this an estate planning conversation, because
Right.
we're talking mostly taxes here. But from a financial planner's viewpoint, from a CPA's viewpoint, what's really nice about that scenario is people should understand, if they're not sure of this, is that you mentioned grandma and grandpa own, right, a
Yeah.
portion. They can control the entire thing with just a small percentage of ownership.
Exactly.
So
yeah.
a lot of people were hesitant to do that when they were first started talking 10 years ago, that this was a big thing. Some people were hesitant. I'm not giving up control of my land or my property.
Right.
I love my family, but no one's taking control over my stuff.
Yeah.
So they can gift ownership of that limited partnership to most of the family. They can give most of it away and still have 100% control.
Right. Yeah. So there's two classes of partners. There's the generals and there's the limiteds. And the
Right.
generals hold the decision-making power.
Exactly.
Most of our partnerships that we do, I'd venture to say basically all the partnerships we do, the general partnership interest is either 1 or 2%.
Yeah.
But that's the decision-making percentage.
Yeah. As usual, as an accountant, you say what takes me 2 minutes to say, you say it in 2 seconds. So
Yeah.
I appreciate that. And that goes to that last topic we have, which was basically educating your family members. So if you are thinking about doing this kind of arrangement, or more than likely you already have it set up.
Yeah.
There are those who got it set up a decade ago and haven't really dusted it off to really see if they're managing it correctly, what they're doing. They're just doing a tax return, putting the money somewhere, but there's probably a lot more they could do by educating themselves and absolutely by educating the owners of the limited partnership part.
Yeah, and that's something I see a lot of that concerns me. The general partners, those 1 or 2% partners, need to educate who's next, because at some point in time they're going to have to step up and take over.
Yeah.
And if they have no clue what's really going on, not that they're overly complicated, but I have some that have quite a lot of partners. You get into some that have 15, 20 partners. Yeah. Everyone's got different percentages. You've got out-of-state partners, and there's Pennsylvania withholding estimates to send in, and some things that need done. And you don't want to just have someone be surprised to step in and have to figure it all out from scratch. It's not that hard to sit down with them a few times and go through the checkbook and here's what I have to do every month and put together. You should be checking your stubs and making sure they make sense and stuff, because the gas companies mess up. Yeah. So just show someone else what you do so that they can do it if they have to. I just
had a conversation with let's say an executive in a gas company, right? And the conversation, I was relaying a situation I had years ago where I found an error. We had a client who was getting royalties, and we found an error in his checks.
Yeah.
It was to me, it was a clear clerical error. It was a redundancy from the 2 months in a row, but it was about a $15,000 mistake.
Yeah.
And I said to him, I pointed out, and he was like, "Wow, that's huge. I can't believe it." And I said, "So are you going to call?" And he said, "No." And I was like, "What do you mean?" He's like, "Well, he didn't want to bite the hand that feeds him."
Yeah.
And I get that to an extent, but I was asking this guy this morning about it, and he was like, "Oh, he should have called." I mean, mistakes happen.
Yeah.
They're usually unintended. We like to think so. And, he should have called with that simple question. At least we could have said, "No, it's not a mistake," but we wouldn't stop paying him royalties.
Yeah, right.
So there's a lot of misconception out there. And what you just said hit home for me, because it doesn't matter if you're an individual, if you're just mom and dad with some retirement assets and 1 or 2 kids, you want to make sure they get what you don't use up in your lifetime, or you have this family limited partnership with several family members involved and assets and land and legal entities. If the next man or woman up doesn't really understand what to do, then they're either going to make a lot of mistakes trying to figure it out from scratch, or they're going to hopefully walk into firms like ours, and we can at least guide them. But it's such a smoother transition. If they don't need to know everything, but just know the basics of why it's set up this way and what our intent was and that stuff. And that's usually an easy conversation to have. I've been involved where they've asked us to sit in on those meetings to kind of be the interpreter or whatever, to talk about some of that.
Yeah, it's a relief for us. When the next person up comes in and has a little bit of a grip on what's going on and what to do next, because sometimes those conversations are hard. If someone passed away, like, they're grieving,
exactly.
And the last thing that they need is to step into this, and it's messy, and they don't understand what to do and how to do it next, and we end up having to help, and we have to bill for our time, and it's not always the nicest situation. So it's worth the effort to get someone involved and get them trained up, and it makes the transition easier for us and for them.
Yeah, I agree with 100%. They're focused on, how do I have coffee by myself all of a sudden tomorrow? Right. It's hard to think about the next 5 to 10 years at that moment.
Exactly.
Ben, this is fantastic. So the overall theme, though, is finding flexibility. It can be this year in your tax return. It can be planning out 5, 10 plus years.
Right.
But looking for, that flexibility is coming from having things coordinated and knowing what all those levers or buttons you can push or pull are at your disposal, and then you can just use some, turn them on, turn them off in any given year.
Yeah.
As the tax laws change every single year.
Right.
There's always something. Keeps your job interesting. So
sure.
Anything else for the good of the cause before I let you go?
No, just as you're trying to build that flexibility, give us a call. Most times it's just a conversation. Sometimes you guys have great ideas. Sometimes they're not so great ideas, but bounce them off us. It's not a huge thing to have a conversation. So come up with some plans. Just put some things in place so you can have a more flexible future.
Yeah, that's great. And I would say my last input is, as I talk to the camera, is since working with Ben through our accounting office at Stonehouse, and then also through our investment office, which is where I spend most of my time, having these two hands talk to each other is where that flexibility comes from. So do your best. If you're not letting your accounting professionals talk to wherever you have your money invested, or you're doing the money investing yourself, make sure the accounting professionals know what you have and what's out there so that it all plays well together. So hopefully this was helpful, and thank you to Ben DeNault for joining us, our CPA in-house at Stonehouse, and we will see you on the next podcast.